Hello friends, today I want to talk about how can you pay minimum amount of taxes possible. So every now and then you probably see some sort of news, maybe on YouTube or social media where somebody claims, hey, particular CEO paid almost nothing in taxes, or XYZ earned $1 billion and paid nothing in taxes, or ABC moved out of state because they wanted to save on taxes, and many other kind of statements like that. And you probably think, well, that doesn't really apply to me. I'm not a billionaire, or I'm not planning on moving out of the state. So is there any way I can save on taxes? And I think this question, yeah, I'm sure comes to mind for many people, but they are scared to go to a professional to discuss their situation. And then I don't blame them, because many professionals are not really trained in planning aspect of things. They're mostly trained in preparation, so they don't really talk about planning. So today I'm going to talk about, when people come to me for a comprehensive tax planning, what kind of things do I do? How do I help them save on taxes? What kind of framework I walk them through? So this kind of gives you an idea. So maybe even if you're not coming to me, maybe you can start thinking along those lines that can help you. So I hope that will be very helpful to you for 2026. So a lot of time, when people think about taxes, what are they thinking? They're thinking about, well, I earned some income for last year and now I want to file my taxes. As for majority of the people, that is it from tax point of view. But people who have high income, people who are business owners, people who have a lot of assets, who have a lot of wealth, they want to plan their taxes before the income is earned. So for example, right now is February 1st, 2026. A lot of people are going to start coming to us now because they want to file their taxes for last year, for 2025. But after the tax season is over, a lot of people are going to start coming, especially the high income people who start coming in because they want to plan for their taxes for 2026. Like, okay, what can I do this year that can help me pay lower taxes? So today, that's the framework I'm going to walk you through. I'm going to assume that you're one of those, okay? Even if you don't consider yourself in high income tax bracket, okay? Even in that case, strategies still apply to you. Maybe obviously benefit won't be as much as to somebody who's earning $1 million or $10 million or more, but you are still going to save a lot if you follow the framework. So, basically the IRS, the way the tax code is structured is around how a particular person behaves. So let's say if you eat healthy, you exercise, you're going to be rewarded for that, right? You're going to be in better shape, you're going to live longer, you're going to be healthier, versus if you have bad habits, maybe you smoke, drink, maybe you don't sleep on time or you don't get enough sleep, maybe you eat bad food or you don't exercise, well, those things are going to catch up to you. They're going to penalize you sooner or later. So it's really all about behavior. If you have a good behavior, you'll be rewarded. If you have a bad behavior, you'll be penalized. IRS is no different. They want to reward you if you have a certain type of income, if you use your finances in a certain way. They will penalize you if you use them differently. For example, if you are a W-2 income, or you're a 1099 contractor, maybe you're even LLC. In many cases, tax treatment for you won't be as good. On the other hand, if you are a real estate owner, you're renting out your properties, tax treatment for you will be a little bit better. If you are an investor, maybe you invest in stock, bonds, hey, tax treatment for you will be really, really good. So it depends upon how you're using your income. Let's start with a simple example. Let's say you and me, we both own real estate, and you live in your house and I use that house to rent it out to somebody else. Who is going to get a better tax treatment? So let's think about that for a second. Well, can you write off your mortgage? You will say, yeah, I can write off. You can write off to a certain limit, but yes, you can write off. Can you write off your property taxes? Yeah, now that SALT limitation has increased to $40,000 this year, that's wonderful. Okay, so you can write off your property taxes. Well, what about repairs? all the money you spend on replacing your light bulbs, your Christmas lights, or maybe you redid your kitchen or bathroom, any of that stuff, do you get to write that off? No. What about all the furniture? Would you get to write that off? Of course not. What about your utilities? Your PG&E bill, your gas bill, your garbage bill, can you write that off? You can't write that off, right? But on the other hand, because I also own the same property as you do, but I'm renting it out, I get to write off all of those expenses. I get to write off every single penny of my utilities. I get to write off my, gardener, whatever he's charging me. I get to write off my mortgage interest. In matter of fact, I get to even create paper losses, depreciation that I get to use against my income that I'm earning from rental income. So I earn money and I pay almost nothing in taxes. And guess what do I do with that income? I can invest it in stock market or in gold, silver, whatever, and then earn return on that, which will be even a lower tax bracket. So you see, it can have a wonderful compounding effect on your overall wealth as the time passes. So a lot of people don't realize that. Very, very important concept. So we both did the same transaction. We both purchased the property, but our tax treatment is a little bit different. So now obvious question to me would be is, okay, that's great. So you're just saying that, hey, buy a real estate that reduces taxes. No, that was not the idea. The idea was just to show you that we both did the same transaction and our tax treatment is completely different. Now, when you come in for comprehensive tax planning, we look at all kind of different angles as to what your goals are, what your cash flow looks like, what kind of business you have, what are you planning to do next year, what kind of things did you do last year, what else you want to do with your money. We really get deep into it and try to understand what you're trying to do. Because once I know that, that is when real strategies will start to emerge. There's no like a checklist that I go through, okay, this strategy, that strategy, and whatnot. And I'll tell you an interesting story around that maybe towards the end of the video. But today I'm going to share some ideas. There's some basic elements that we go through with every client, okay? These are just some basic stuff that you can perhaps even do it on your own. But I think to do it properly, it's a good idea to get somebody professional involved in it. So let's say, first, you need to understand what kind of income you have. Most of us have three types of income. Either we have an earned income, also we call it active income. That means your income is coming from your hard work. That means you're spending time on it, like W-2 wages. Maybe you're a 1099 contractor. You have some sort of self-employment income. And in those cases, you will be subject to three types of taxes. You're going to be paying your ordinary income tax like the rest of us. You'll be paying your state taxes. And then you will also be paying your payroll taxes. If you're self-employed, that number can be as much as 15.5%. So quite high. Now, this is on top of your state taxes and your federal taxes as well. So you can see that can be very penalizing. And I bring up this because many times I talk to people and they think they have an LLC and that's why they're in a lower tax bracket. Not true. So keep that in mind. That might not be the right strategy depending upon what kind of business you have. So these kind of people who are in this particular bucket, and which I think many of us are one way or the other, this is the worst bucket we can be in. This is where we get taxed the most. Second bucket is passive income. For example, rental income, or maybe you invest in a business, but you don't really work in that business. Guess what? Now I don't have to worry about payroll taxes. And then whatever income that I do generate, I can oftentimes offset it with some sort of depreciation or expenses that I might have in my business or in my rental property. So I like that. So I would prefer passive income over the active income. And the third bucket is investment income. For example, when you invest in stocks, bonds, crypto, anything that generates capital gains. I love that because they're oftentimes lower tax bracket. For some people, that could be 0%. For some people, that might be as high as 24%. So depending upon how much income you have, but still, it's better than if I have an active income. It's a better tax treatment. So the first thing we do when client comes in, we take a look and we divide the income into those three different groups. What is it doing in actives? What is it doing in passive? What is it doing in investment? For most people, they're only in that one bucket. They don't even have the passive and the investment bucket going on. So if you are one of those who are in that particular category, I should strongly urge you to become part of our coaching program member, because in coaching program I discuss in great details how you can save, how you can build, how you can invest. You can learn about all this stuff, before going blindly and just making a mistake. So once we have defined those three buckets of income, now we can look at and see what can we do for this particular client. For example, first thing we would look at is, well, from their higher income tax brackets, can I shift some income elsewhere? Can I shift it to family members? Maybe they have kids, parents, maybe some uncles, somewhere else outside of the United States, maybe. And I say, hey, can we engage these people in one way or the other and transfer some of that income to them? That means that particular transfer actually becomes an expense for us. Are we able to do that legally? So again, I can't tell you how to do it because that's different for each person. So we have to brainstorm together and see how to do that. Then I look at, is this person properly set up? Sometimes we need to set up an LLC, sometimes S Corp, C Corp, sometimes multiple entities in order to get the best tax treatment possible. Is this person have proper retirement plans? Are they saving properly for their retirement? Do they have proper medical plans? If they're into charities, how are they doing those charities? So we look at overall, can this income be redistributed strategically? Is that possible? So that's idea number one. Then we take a look at deductions. For example, obviously, most people are familiar with standard business deductions, but I'll just pick some common ones that are often missed. Home office. Oftentimes, people just take a standard home office, but maybe that doesn't make sense for you. Maybe you should be taking an actual home office deduction. Sometimes people are taking a home office deduction, but it's done wrong because they take the home office deduction, but never report the depreciation on that on their property. So when IRS looks at it, they're like, that doesn't make sense. They're reporting actual home office deduction, but they never took a depreciation on that. Well, if you're telling IRS that that is a business property, then why are you not taking a depreciation? Anyhow, that's a topic for another day, but I'm just saying oftentimes it's done wrong. But you can certainly take it. Augusta rule is another commonly one that people miss, being able to rent your home to your business and not have to report any kind of income tax on it. So that's a pretty cool strategy. A lot of time people have some fringe expenses. So we have to take a look at what kind of expenses they have and see, can we structure them in such a way that we can write off on the business? Like, for example, a good example would be medical expenses. You guys know that, right? We can't generally write off medical expenses. Then people don't even want to use their HSA funds because I think most people understand how HSA work these days. They would rather leave the money in HSA and let it grow tax-free for a long time. But then they're paying that, doctor visit, they're paying for all the expenses from their credit card. And now what? Well, guess what? You're able to deduct those as well, but you have to structure it in a way that you're able to deduct them. You can't just directly deduct them on your tax return. So we take a look at those kind of things. Then, disposition of assets. For example, if you have an investment that didn't really go that well, maybe you have a rental property that is not really producing any money. Maybe you have stocks that are not really going to recover anytime soon. Maybe you have some losses in crypto. Can we use any of those things to do two things? Number one, if you get rid of them, then you stop the bleeding and now your portfolio can start to go up. That's one. And number two is now we're offsetting capital gains from elsewhere. So we take a look at, are there opportunities around there? Are there, deductions that we can take that are not really on your bank account, on your credit card statement? So for example, when you're doing your math for profit and loss, you're always focused on what expenses you have, right? But there could be certain things that would never really show up in your expenses at all. Can we use those? Depreciation is the easy one. Sometimes we might even do cost segregation because we want to take extra depreciation. Now we have bonus depreciation. Again, none of this will show up on your paperwork. Maybe you bought a car or a truck or something for your business. So we're looking at some of the paper losses that might not actually show up on your bank statement, but can we properly use them? And by the way, just because you have an expense doesn't mean we need to take it. Sometimes it makes sense not to take an expense. Now, that's a topic for a whole another day. I don't want to get into that, but that's another aspect we need to look at during the tax planning. One of the biggest things that you can do with tax planning is controlling how you expense or how you earn income. The both ways you can control, right? Those are the two levers: income and expenses. If you can control them when those expenses happen, that can have a meaningful impact on your tax return. So, for example, maybe you have an expense that you do regularly, and this year you just have a lot of income. Now, you know you're going to have an expense next year, but what can we do? Because, if we end the year, I'm going to have to pay taxes. Well, wait a minute. Can we somehow structure things that we can even write off next year expenses? Possible, right? We just need to structure it properly. If you have a particular, maybe you're selling a real estate, it had a lot of capital gains, maybe we can look into installment sale. Maybe we need to do 1031 exchanges. Maybe we need to set up a retirement account for you, for your wife, for your kids. Maybe we need to even look at defined benefit plans. All of these ideas are around controlling when an income and expense is registered for the tax purposes. So sometimes these strategies can be very, very powerful. A lot of us like to donate money, and again, starting this year, writing off donation expenses become even harder on our tax return. But there are a lot of ways to do this. For example, we have CRUTs, we have a different kind of charitable trusts, we have foundations we can set up, there are donor advised funds, there are a lot of different charities. So we have to think that through as to what a client is trying to do with that money to see how to structure it so we can minimize the taxes. So there's a lot of stuff goes on in a tax planning session. Oftentimes it happens over multiple calls. So I think many of you guys probably haven't gone through the exercise. Nobody spent 7, 8, 9, 10 hours with you to kind of walk you through all kind of things that you can do in tax planning. So if you haven't been going through that exercise, or maybe whoever you work with, they don't offer that service, I will urge you to try us out. I think it's if you go through that exercise one time, you will look at the world of finance completely differently. So you can buy the comprehensive tax planning sessions separately, or you can buy the coaching program that includes the tax planning at no cost to you. So both works. And when we do tax planning, we just don't look at some of these strategies. We also look at estate taxes. We look at kids' education. We look at the retirement accounts. We look at asset protection. We look at who else we need to involve in our tax planning, who can help us make sure you get the best of everything. Sometimes there's inheritances involved. Maybe you have people who be inheriting your business or your property, and maybe, for example, sometimes I talk to people, they want to give that business to their kids, but their kids are not even qualified to run that business. So what do we do in that situation? Sometimes people have life insurances that are full of fees, and that policy is not moving at all. They're just paying more and more into it, and they're not able to grow their wealth. So it's like really, really hurting them. So there's so much more goes on. Education expenses, medical expenses, retirement. Anyhow, I think you start to get the picture that when I say comprehensive, it's really comprehensive. A lot of us like to gift, to our, for example, many of you guys are probably giving gifts to your, for birthdays and other things that are happening in your community, but you're probably not writing any of that off on your tax return because you never had a discussion around how can you make that happen. One quick point I do want to make around this is sometimes I see people selling packages for a lot of money, like $5,000, $10,000. And what they will do is they will give a big book of different tax strategies. And the client think that they can come, at the year end and take several $100,000 of deduction. And this has happened to me when I look at those books and I'm like, well, first of all, they're like 200 pages, 300 pages. And I have to kind of go through each page. And I tell them, hey, this will not work for you. This would not work for you. This would not work for you. And then obviously people pay a lot of money for those tax plans. So they expect me to explain to them why that is the case. Again, that's not fair to me because I'm not doing your tax planning. Somebody else did it for you. So it's best that you get tax planning done, whoever is going to be signing your tax return, because they understand you. They want to stand behind your tax filing. So if you go through them, then you'll get the best results. And like, for example, we don't charge a whole lot of money compared to these $5,000-$10,000 packages, nowhere even close. So they're ridiculous in my opinion anyway. So anyhow, if you want to know about comprehensive tax planning, give me a call. Just set up a discovery call. Let's talk. I'll explain to you what that is all about. And I think if you have never gone through it, I think you're going to enjoy it. You're going to absolutely love it. And that is going to change the way you look at your finances going forward. I think you're going to see a lot of benefit. So I hope this helps. I just kind of give you a taste of how the tax planning works, but there's so many more elements that we look at when we go into the entire exercise. Just go to taxcodeadvisors.com, and set up a consultation call with me, and then I'll see you next time. Thank you so much, guys.